and I welcome all of you to Family Center's Titan Speaker Series and the first Titan event we've done virtually. I want to shout out a great big thank you to our very generous underwriters and sponsors whose names you can see on the screen next to me. This event was made possible through the efforts of our amazing Titan co-chairs, Marge and Bill Berkeley, Nancy and Dominic Casserly, Mary and Garrett Moran, and Jeannie and Rick Whitmer. Thank you all. Special thanks go to Family Center's board member and the Reverend David Van Dyke and the First Presbyterian Church of Stamford for hosting us today. Thank you, David. This event is being offered free to the public. However, this is an important fundraiser, and every dollar raised goes directly to Family Center programs helping families most negatively impacted by the COVID-19 pandemic. Thanks to everyone who's contributed so far. For those of you who would like to make a donation, you can text Titan, T-I-T-A-N, to 91999. That's 91999. Or visit the link at the bottom of your screen. We are honored to have as our Titan speaker today the legendary investor Steve Mandel, founder of Lone Pine Capital, a major thought leader in philanthropy, and a longtime supporter of Family Centers. The presentation will run about 40 minutes, and then Steve will take a few questions. If you wish to submit a question, please enter it into the chat. To introduce and interview Steve, I'd like to call on our Titan co-chair, Garrett Moran. Garrett is past COO of Blackstone's private equity group. He served for 6 years as the president of the nonprofit Year Up in New York City, and recently stepped down as chairman of the Governor's Workforce Council in Connecticut. Garrett, I'm turning it over to you.
Thank you, Bob. Good to be here tonight. It's great fun to be able to interview Steve, and I'll start off with an introduction. Many of you know the story, but Steve is a Fairfield County boy. He grew up in Stamford and Darien and has lived in Greenwich for many years. He got his education at Dartmouth and at Harvard Business School. And the big pieces of his education, or rather of his career, started off really at Goldman Sachs, where he was a retailing analyst for many years. Then changed over to Tiger Management Company, the legendary hedge fund run by Julian Robertson, where he worked for another 7 years or so, and then left to start Lone Pine Capital in 1997, so 23 years ago. To give you a sense of the degree of success, if you had put $1 into the stock market in an index fund when Steve started the fund, it would be worth $6 today. If you had put $1 into Lone Pine when Steve started the fund, it would be worth $25 today. That's really cool. Steve's fund, Loan Cascade, long-only equity fund this year, year-to-date is up 40%. So he assures me that that's not a guaranteed return, but the numbers are quite remarkable. Steve was formerly chair of the board of Teach for America, as well as Dartmouth College, where he went to school, and he is the founder of the Lone Pine Foundation that you'll hear a little bit about later on, as well as the Zoom Foundation, which is their family foundation that's got about $1 billion of assets ready to be deployed to the betterment of mankind. Steve has been married to Sue, and they have 3 grown children, and last week had welcomed their 3rd grandchild. Congratulations.
Absolutely.
So with that, I'm going to just have a conversation here. I think the idea is to talk about both the business career and Steve's philanthropy and Steve and Sue's philanthropy. And I thought I'd start off, Steve, with just a general question about in your investing business, what are the key things you look at when you're following a company? Just a broad brush.
So I'd say there are a number of things, of course, but as one goes longer and longer in this business, spend more and more time thinking about people, thinking about the characteristics of the people running the business, not only how smart they are, but what their ethics are, how they set a culture at the company. And so obviously we spend time on, companies' competitive positioning, what their financials look like, what kind of sustainable moat they have around the business. But more and more, we spend a lot of time really trying to understand the people, how they think, what kind of culture they've created, how they motivate their people, what kind of people work there. It's just become more and more over time spending on people.
So that's the kind of thing that's hard to do when you're picking up a company for the first time.
Yep.
So what, in practical terms, I mean, I think as a business Wall Street guy for my career, I think there's a sort of convergence between someone who delivers good numbers and someone who's a good leader. People tend to equate the two, and oftentimes that's it. But how do you live that? How do you make that real, given that it takes time to figure out the character?
Right. So there's really two things we do. One is we try and spend as much time as we can with them, which is, there's limited time. We can't monopolize their time, but we try and spend a lot of time, particularly with the CEO, but with the senior management group broadly. So we, try and visit them wherever they are and spend as much time as, frankly, they'll let us. And that varies between companies a lot. And then we spend time checking them out through both our networks of people we know, but also one thing that has evolved, and we weren't doing this so much at the beginning. We've kind of evolved to do this over the last, 15 years or so. There are a bunch of generally former journalists, former reporters who have kind of carved out a niche, being able to get former colleagues of management to talk and find out all kinds of things about how they ran the business, how they treated their people, how they compensated people. And it's shocking, frankly, how good these people are at getting people to talk and the level of detail they get into. So we get literally transcripts from these interviews, and we'll have a dozen or so on an individual, and it helps it helps paint a picture. I mean, we form our own judgments by meeting with people, but it is very helpful. People have worked with people for years in getting their perspectives.
Yeah, I've spent a lot of time in my career hiring people and having headhunters do the due diligence. And at one point at Blackstone, we figured out just what you described. There's a professional who does nothing but find people who used to work with the management team and ask them really, really good, deep questions.
We have 2 or 3 people who they don't work exclusively for us, but they almost do. And they're not employed by us; they're third parties, and we pay them as such. But they do a really, really good job.
And so, are there other tricks for sort of persuading or tricking managements into spending more time with you?
Well, I would say this. One thing we try to do, and hopefully we're more successful than not, is be a resource for them. So if they think that we know a bunch about emerging competitors, or we know a bunch about somebody they might consider hiring, if they view us sort of as a intellectual peer, in effect, that's really, really helpful. And that changes the nature of the dialogue with management considerably.
So all that suggests, though, that you're spending a lot of time on an individual investment. Does that mean that you hold things for a long time, or how would you characterize that?
We try to hold things for a long time.
Yeah.
When we enter an investment, we think we're going to hold it. In general, sometimes I would say we have, this is a gross oversimplification, but we have businesses that we expect to compound value for a long time, and we expect to hold them for a long time. Sometimes we make a mistake and we don't hold them for a long time, or sometimes stock price gets ahead of where we think the return profile is and we sell it. but we have other types of investments where there's a catalyst for realizing value, when new management comes in, an acquisition, something that's a catalyst for driving value where there may not be a long-term compounding of value, but there's a closer realization of value.
So if one of your analysts comes in and says, wow, I found this company, it's just cheap, every which way I can look at it, and they're no point of view on management, how do you deal with that? If it's not a company where,
Well, in general, we would probably need to find some type of catalyst for the realization of that value. And yes, if something is abjectly cheap relative to its intrinsic value, yes, we would absolutely look at it. We would go through a process, though, of trying to understand the management, what they're trying to do to realize value. We are not activists. I would say we are, I guess there's a word that's come into the lexicon, suggestivists, where we will engage with boards and with management about, if we don't think they're doing everything they should to run the business right or realize value, we'll engage in a dialogue with them about that. But we don't go public with that or wage proxy fights or do that kind of thing.
Do you have any, I know we agreed when we talked about doing this first that we wouldn't mention any names of stocks in particular, but given the...
Only because we have to restrict them if we mention them. So.
But given that limitation, are there leaders of, management leaders from companies that you think of as sort of paragons? Are there, the beyond the sort of common names that people...
Well, I grew up as a retailing analyst way back when, and basically I had sort of two management teams that I, looked up to and kind of basically idolized. One was Sam Walton at Walmart, who, just had an incredible facility with people like I've never seen anyone before or since. He would... every year they would have the Walmart annual meeting. Initially it was in their little cafeteria or whatever, and then the audience got too big and they actually built a new field house at the University of Arkansas to hold it, because they had it in the field house and it was unair conditioned. The meeting was in July and it got pretty oppressive in there. So Sam's brother Bud built a new field house for them so they could play basketball games but also have the annual meeting. Anyway, he would be in there. Every store got to send 3 employees, associates from store to the annual meeting, and they would come, 24 hours by school bus from, Ocala, Florida to Fayetteville, Arkansas. And so he would literally at 5 in the morning, he would get there and he'd be up on a stage like this, and all these associates would be, down there, and he'd be just, oh, Betty Lou, I was in your crafts department in Ocala and you had this great display. And, you just sit there and watch this and just go, this is just like unbelievable. So, yeah, them and Jim Sinegal and Jeff Brotman at Costco were 2 people also that I just thought the world of in terms of the kind of culture they built at the company. This is a company that, I can mention these names because we're not involved in either, but this is a company that is able to offer the lowest prices on the highest quality goods, and at the same time pay their people at the top scale and offer the best healthcare benefits of anybody in the retail business at the same time as offering the lowest prices for their consumers. And just thought, they had built it. And if you go into Costco and you just look at people's badges, always says when they, says their name, but it also says when they started. And I was just in there the other day, and the 2 people I was dealing with, one was 1999 and the other was 2003, right? They, and they're very proud of the fact that a 2-cashier household can lead a middle-class life in America. Right?
Yeah. So what are the What about heartbreaks in terms of management teams that you misread?
Oh,
or
God.
situations?
Yeah,
This would be a lesson that people could listen to and maybe take something away from.
Well, there are two situations. We're not involved in either, so I can mention both names. One is actually that we had large positions in and completely botched. That we botched many things, but these turned out to be fantastic investments, and we had the businesses analyzed correctly, but the managements at the time, managements have changed in both cases, managements at the time were just screwing up, and we just couldn't take it anymore, basically. That they was like, I cannot back these people. And first was Green Mountain Coffee, which ultimately was acquired for a large multiple of the price that we sold it for. And the second was Lululemon, which has turned the company's worth nearly like $50 billion today. And they've always had a fantastic business, but they had some.
So was the heartbreak both that they disappointed you and you sold the stock too early?
Yeah, well, I mean, they were disappointing us in terms of how they were doing. They both had terrific businesses, but they were mismanaging them, and then we bailed because we just sort of couldn't take it with management anymore, and then eventually management got replaced, and they started realizing the intrinsic value of the business.
So I'm interested in delving into the areas of innovation that you're looking at, and maybe for our audience's purpose, you could describe sort of the sectors broadly that you're in, and then we could maybe talk about what's exciting today.
Yeah, one of the, we're in a very unusual time in many respects, right? I mean, obviously with COVID going on, but we're in an extremely low interest rate environment, which creates a lot of economic distortion, frankly, and is, frankly, beneficial to people like us and often hurts people who do not have capital to deploy. But we're also in and this is one of the most exciting things about being in the business that we're in, the level of innovation and the level of progress coming largely from new technology is just like we've never seen really in the history of the world. And so the areas that we find the most interesting there, and there's a lot of things going on, but I would say digital payments is one area. So, for a long time, the cash and check has been moving to various forms of digital payments, but this is accelerating rapidly and is moving both across the world, is moving not only to consumer payments, but business to business payments as well, and is allowing many people who've been unbanked before and had difficulty dealing with the banking system to really enter through Cash App and other forms of saving money, basically, or handling money, entering the economy in a digital way and not having to deal with cash as much. So that's one area, and there's kind of innovation happening there all over the world, and it's being replicated in a kind of a similar way in basically almost everywhere in the world. The software space, so that you've had a movement from, physical software that you're, deploying to what are called SaaS models, software as a service models, where software is, in the cloud, and that has changed not only the economics of that business, but the ability to innovate faster, and so that software is infusing every aspect of society. A third area will be the digital consumer, So this is not only just e-commerce broadly, like we think of with the major e-commerce players, but it also gets into how we communicate, gaming, consumption of video. It's a broad phenomenon that's really changing how people not only consume products, but also consume services, entertainment, et cetera. And so those are three large areas we invest in, and a fourth would be what's happening in biotech, and that deals with targeted therapies, personalized medicine, and kind of the merger of software and biology, which is happening as we speak.
So if we think about how we live our lives today compared to 10 years ago, a huge amount has actually changed. The things we take for granted that we do with our phone and so forth dramatically. Right. We're going to ask you to give us the crystal ball 10 years from now. What will seem routine then that we're not sort of thinking about now? And it might be for poorer people as a class, or it might be, internet. I'm not.
Well,
in other words, it might not literally be us. It might be.
Yeah, I think a number of things. I think it will be. I don't know the exact time frame, but I think personalized medicine will be standard, meaning that everybody will have a genetic profile, and that genetic profile will determine, your predisposition to certain diseases, and you will have a personalized, and I hope this permeates to society broadly, but it will, probably start, unfortunately, with people who are better off, but that will be standard. I do think, I think it'll be a longer time coming.
Before you get away from that, what does that mean, that personalized medicine will be standard?
So it means that your genetic profile will be with your
my doctor,
with your physician,
right?
And off of that, you may have there'll be preemptive things that will maybe if you're predisposed to have a certain type of cancer, for example,
right?
There may be genetic engineering that will change that predisposition. There could be, other preemptive interventions that could stop that. So you would, that's.
You're looking though at software and medicine. What's going to make healthcare stop inflating faster than everything else?
That is a real. That's a really hard question because even in the world where, like if you look where there is. National health care through European countries, Japan, et cetera, they're inflating too. Their costs are lower than ours, but they're also inflating.
Yeah.
And that's a really tough one because if you look there are things we can do to slow that down, and there are certain aspects of managed care that are very good at that. And the way that works best in this country is if the entire system, like you have at, Mayo or Intermountain Health, et cetera, employs the docs and basically can manage the population health through that whole geographic area. That's a way. It's going to be a long time for us to get to that point. But there are, drivers that are, if you look at pharmaceuticals, for example, which has increased a fair amount. It's up to close to 20% of healthcare spend now, which has probably doubled over the last 15 or 20 years. All of that is through innovation. So 90% of the drugs prescribed in the United States today are generic. Low cost, generic, in terms of number of scripts. But every day that goes by, there's a new innovation, often for rare diseases, certain types of cancers that are life-changing for the people who have them, but there may only be 50,000 patients, 10,000 patients. And so the economics of that are such that, if you're going to support the research and the clinical trials and all that go into that, the drugs have to be priced at, $200,000 a year. And it's very hard for the FDA to say, no, we're not going to.
Yeah.
And so that, even though 90% of the scripts are generic and low cost, that 10% are really expensive.
Yeah.
But they are often, the difference between life and death for people, or between a very compromised life and a more normal life.
Yeah.
And so.
Are there, you're, a couple of things occur to me listening to you. You have to have a bunch of experts on your team. You have a small team of people, right?
We have about 15 investment people.
Yeah, and you're talking about some pretty esoteric topics. So I guess you've got some really smart, focused people.
We try and focus our people. There's a lot of things we don't really spend any time on. We don't look at utilities basically at all.
Right.
We don't really
Right.
look at commodity-based businesses. So there are a whole bunch of things we spend very little time on.
Right.
And we also leverage outside expertise. We do not have PhDs in biochemistry on our team. We have basically 2 or 3 people who are, and we don't do a lot. And healthcare is not a huge space for us, but it's a interesting space. We have a number of people on the outside that we pay a fair amount of money to, who have that expertise, and we lean on pretty heavily, certainly on the science side of things. And we do that, across various spaces. Whether it be aerospace or, we have people on the outside that we rely on.
So you spent about, I think I calculated, about 15 years in your post-MBA career before Lone Pine, and 23 or so since then.
That's about right.
When you started Lone Pine, and if you look at what you were thinking about then and what you're thinking about today, what did you probably opened to thinking you really knew what you wanted to do. You had 15 years of experience. You had been investing. Are there 1 or 2 things that you really learned in the course of running Lone Pine that you sort of didn't expect to learn, or were you just have you been relearning things you knew when you walked in to set the place up?
I had certain, I think the principles that we had if you looked at our original business plan, and you looked at it today, the investing principles and the principles about running the business and how we treat our partners and how we treat our people and all that are the same. Those are the same. And that's been sort of a bedrock of what we've done. But if you look at other things, we said, kind of the maximum amount of money we can see managing is a couple $1 billion. Now it's 30. We were just a long-short hedge fund at the time, and now we are we still have that, but the larger amount of capital is in long only. I felt we could run with a team of, we had 17 people at the start. I felt like there's not going to be a need for any more. We now have 95 people.
Right.
I was like, I don't want to have all this, I want to keep it very lean, and we're not going to need a general counsel, and, now we have a, general counsel and compliance department of like 6 people,
Right.
So things.
Those are
change.
normal growth things, though. You have a reputation, the firm has a reputation for being a great place to work, very sort of humane, good culture. And I'm assuming from what you've just said that was sort of part of the plan.
Well, I was just talking to our COO today, and we had just gone through reviews last week, and I was just so proud and so thrilled to, because many of the people, I have sat on every single person's review for 22 years. Never missed one.
Wow.
And, it's always, but now, I used to know, when we had 17 people, I knew basically what everybody did. Now I know what everybody does, but I don't really interact with a lot of them on a day-to-day basis. And so seeing, and COVID brought this out too. I mean, because it was a forcing mechanism when we work remotely and all that. The innovation and the implementation of stuff that we've done over the last, 8 months, was just, and seeing the not only the commitment, but just the new things that people have done, implementation of all kinds of new technologies within our firm, just in the last 8 months that probably we should have been doing, before, or were doing before, but not to the same extent, right? I mean, Trello and Slack, and so that, and hopefully this doesn't come by accident, meaning, we set the place up so we're, we have 95 people and we have, I don't know, somewhere pushing 40 people are owners. We have, we've always, we didn't really think about diversity, equity, and inclusion when we started out. I mean, that term didn't even exist, but we sort of always have run the place that way. Have by far the probably highest female leadership and ownership of any firm like ours, and we've always had a inclusive philosophy, both in terms of ownership, but also many firms like ours sort of run like two classes of citizens. You kind of have the investors as one time and everybody else is the other, and we haven't done that. We have more owners in the non-investing people than we do in the investing people, and so all that hopefully helps, and then we try to do all the sort of what I'll call the little things, right? Best health care we can get, highest 401k match, matching gift, our foundation, which we'll get into in a second, I guess. But all those things.
So good window onto how you think about the business, and a good transition to philanthropy. It'd be great for those of you who don't know Lone Pine. It's for those who know anything about Lone Pine have probably heard about this, but you guys have a really interesting philanthropy model. Why don't you describe that for folks?
Well, I kind of learned it and we modified it some, but when I was at Tiger, we had a foundation that we started that was Julian's idea, and it was, initially we were a very small group. I think there were 15 people when I joined, and so we started, and it was just, it wasn't, everybody contributed. It wasn't, like a tax on the profits, right, that you had a choice of contributed, and everybody was highly encouraged to contribute, and it was focused predominantly on children and families, social service type stuff, not totally unlike what Family Centers does, in the New York area where we were. And so when I started Lone Pine, I wanted to do something similar, and we modified it some in a number of ways. So the way it works is everybody who's an employee is a board member. So everybody who's an employee has a vote. We have the same thing. We encourage, we just got 100% participation this year. We encourage everybody to give, because when we give to organizations, one of our asks and requirements, in fact, is that the board of those organizations are 100% contributors. So we have that, and we have a small staff of 4 people, and they are doing most of the due diligence on, and it is focused on children and families in the areas where we operate. So New York and Fairfield County, and then we have a small office in San Francisco, and so we used to have an office in London, where we still do. We're in the process of people there are moving back here, but and then every employee has the option to serve on what we call a return on investment group, which is a small group of people analyzing each one of the potential investees we look at, and the staff, the small staff of 4, also work with those groups, but they also work with the employees individually on their own personal philanthropy, whatever that might be, that might have nothing to do with what Lone Pine Foundation does. And then I think the other part of the model is really trying to work with the organizations that we fund to help them, not just give them money, but convene them together, provide professional development for their people, do all kinds of things to help them beyond just writing them a check.
What's the biggest difference between picking a great company and picking a great nonprofit?
I think there's one aspect that's pretty much totally the same, and that's the leadership of, and maybe even some ways more important in the nonprofit, because it is even in many ways even more reliant on a leader or a small group of leaders. And our diligence is not quite the same. We don't hire out,
Right.
ex-Wall Street Journal reporters to go, talk to Bob's former colleagues, but we do try and get to know the leadership of these organizations well, and back people who are real leaders. The other part, the scorecard part, is much harder, right? Outcomes in the business world, are very tangible, right? They are measured in dollars. They're measured in, physical outcomes that, you can track and judge. So there's a scorecard that is, very frequent, and it has many components to it. In the nonprofit world, that varies, and it's tougher. Some organizations, so if you're supporting, let's say, a charter school, the metrics are relatively straightforward. You know lots of things about how students are doing on test scores, on graduation rates, on attendance, on social emotional indicators. You have a pretty good, but on organizations that are trying to foster system change, where you're interacting with the political system, et cetera, and it's a long game, oftentimes much tougher to judge.
Am I right assuming that you've spent most of for you, the single largest time commitment has been Teach for America?
In recent years, yes.
Yeah.
When I was Dartmouth stuff, it was probably
more
of that.
So, and I know TFA has gone through, it's matured and it's gotten into new businesses. Maybe you could talk a little bit about where that's going and kind of what's interesting now. What's the innovation today at TFA?
Well, it really has to do more with the maturation of the big idea behind TFA is you get highly talented leaders, generally right out of college, but there are, increasingly number of people coming into it who had other, who are older and had other professional experiences before they join. And the idea is they make a 2-year commitment to teaching in the classroom, always in low-income schools, both in urban and rural settings around the country, 52 regions in the country as of now. And the idea is that they, through their own personal experience of seeing both the problems that exist, but also the potential in their kids, understand that, it's not the kid's fault. This is a solvable problem. I personally saw, Johnny or Sally, advance, 2 grades by my own personal efforts, and it, affects them for the rest of their lives. And the idea is that, a healthy portion of them go on to be teachers for the rest of their lives, but we want a large portion of them to become leaders outside the classroom, meaning principals, superintendents, elected to public office, business leaders, lawyers doing pro bono work in the community, doctors, et cetera, et cetera. And so, for years, the whole thing was basically, okay, let's get these people in the classroom, let's make them successful in the classroom. Increasingly, the focus gets more and more on the alums, because that's ultimately where the action.
And when you say alums, you're talking about your teachers.
The people who have gone through the program.
Right, not their students.
Not their students.
Right.
Well, and it's interesting, a lot of their students have now become TFA teachers,
Yeah,
right?
okay.
Which is one of the coolest things that happens,
I
right?
bet.
When a kid,
I bet.
and they come and they go back to the same school that they were in. And anyway, we now have, 3,000 school principals across the country. Wow. And, 300 school system leaders, and I don't know, about 400 people now elected to public office, and including, a person in Congress, and, so that's happening, and that's where the action is in terms of the ultimate impact, right? Because those people can actually start impacting the system, right? A teacher can impact their kids, but can't really impact the system. And so the increasing focus has gone there. It's still important to get people into the front end. So the next pivot is to try and hold the organization accountable for what happens actually broadly in the communities that we serve, which is a trickier thing to hold yourself accountable for and measure, but that's kind of the next pivot. But we've had programs all along to get people to be school principals and school superintendents and elected to public office and in public policy positions, et cetera.
And what form does that take? How do you support that?
So all of that's gotten spun off.
Okay.
Okay, so TFA itself, what it does is it recruits, trains, supports those new teachers, and supports its alums really in a way like a college might support its alums in connecting them with each other and helping them find jobs and stuff like that. But the actual work like the public office, public policy stuff, there's an organization called Leadership for Educational Equity that was part of TFA years ago, got spun off. I think it's probably about almost 8 years now. Separate 501c3, separate governance. TFA supports it financially, but at a declining rate, and it is a minority of the financial support now. And its entire being is helping get people, coaching them how to run a campaign and run for public office, tell them where they're eligible to run, getting people into public policy jobs, showing them, training them for that, how to get those jobs. And so that's what that organization does.
Yeah,
right?
okay.
And it's a separate 501c3. And same, so, the New Teacher Project got, spun off from TFA, and they've gotten into, and there's other organizations, Relay, New Teachers, New Leaders for New Schools, that have either loose or tighter affiliations with TFA that perform those other functions in terms of training.
So separate from the TFA diaspora, what's in education, what's got your attention in the philanthropic landscape?
Well, I think big supporter of a bunch of charter schools, and I think a large part of the innovation happening in certainly pre-K to 12 education is happening through a bunch of charter networks around the country who've been quite innovative in terms of their approaches, and I still find that very exciting. I hope that, and this is, I was just talking about this today with somebody else who's a funder in this area, that there actually can be for-profit entities that spin up in the K-12 space that are supplemental to what districts are doing, and and where there's an economic model that can support them. So in China, for example, there are a number of public companies, many of them traded here in the US, and private companies that provide supplemental education to Chinese secondary students from the ages of very young up through 12th grade. And this is test prep, learning English, but it's also just basic math, science, etc. That there's one-on-one tutoring, and then there are huge online classes, and these are large companies. The aggregate market caps of these companies, public and private, is probably in the range of like $100 billion, and
In China.
And they there's huge demand for their services, huge demand, and so and largely because Chinese parents, particularly with single child households, et cetera, are willing to spend a lot of money on this. And so I'm hopeful that my ultimate hope would be we can figure out how to get our system better, but that's a big lift, and there's a lot of entrenched interest not wanting to change that. So some of the solutions, like charters and like what I'll call supplemental education, can be workarounds, and I'm hopeful somehow that we can get this going here in the U.S. somehow, and that there's an economic mechanism for districts to buy into this kind of thing.
Yeah.
And that's a vague idea at this point in time, but it exists in other places in the world, and it's maybe a workaround to the reforms that are needed at district level, which are tough to happen.
I think I'm going to take the opportunity to see if we have questions from the audience.
We did get a number of questions here in the chat. This one comes from Ryan Lynch. Steve, he wonders what non-finance book has had the biggest impact on your thinking?
Everything's a finance book, right?
Oh boy, that's I like to read lots of things. I don't have like a book that I would say is really shaped my life, but I can tell you sort of a books that have made an impression on me are biographies of as you might, I don't know if the cats can see this, but I have my Abe Lincoln socks on here. Biographies of people who've really overcome incredible odds to achieve what they've achieved, are inspiration to me. So, I talked about Sam Walton. Abe Lincoln is a hero of mine. Even reading books, read the Grant biography, I don't know, last year or year before, and you see a character that clearly, had flaws, but also just had an, overwhelming drive to, achieve. And that just people, I've been sort of lucky in my life that I've not had to overcome incredible, had supportive parents and all that kind of stuff, that never had to really overcome incredible odds to succeed or whatever. But that always inspires me.
So going back to finance, Isaac was wondering, looking at the financial landscape that we're currently in and the market being at record highs, he's wondering if you feel that we're on the verge of a bubble similar to 1999-2000.
That is a great question. I think there are definitely elements of that. There's a lot of crazy stuff that has been going on, frankly, some of which we've benefited from. Things going to valuations that I would have never expected they would have gone to. It's interesting. I've thought about so the bubble usually ends when the Federal Reserve takes the punch bowl away. And if you look at the bubble in let's call it the internet bubble of the 2000, it lasted about 27 months. It was really from about September of, when Alan Greenspan, I call him Uncle Al, the speculator's pal, threw gasoline on the fire in September of 1998, and it ended in March of 2000. So that's, my calculation's right, that's about 27 months. And this will burn out too. There's, when the retail investor, is exemplified now by the Robinhood, investor, is heavily involved. I was just actually listening to Bloomberg Radio on the way over, and the volume of open options contracts, this, like right now, is double what they were a year ago. 22 million open contracts, 11 million open contracts here. So there are a lot of aspects to this being somewhat of a bubble. And it will burn it out at some point. I don't know if it's 27 months or sooner or longer. The one difference, though, there's a big difference. The companies that, in general, there are a few that, I'm not sure all these electric vehicle companies are actually going to survive. There are a bunch of things out there that probably will end up being zeros. But by and large, most of the companies that are getting all this, publicity and stuff and all this trading volume and very high valuations are real companies. They may not be worth necessarily what they're trading for, but they're real companies, right? And so in the 2000, the 99, 2000, 2001, era, many, if not most of those companies should never have existed in the first place. They never really had a business. And so that's a pretty big difference between then and now. But there are also a lot of parallels.
Rishi was asking if there was one idea that you had or thought 10 years ago that you were really confident on, that you're maybe not so wild about anymore, what would that be and what changed your mind?
Oh, gosh. I mean, the world has changed in so many ways. The actual economic world. And, I look at the areas that were the biggest areas of investment for us back, let's take it even more, 20 years ago versus today, are areas that we basically almost don't invest in at all. So we were pretty significant investors in retailing back then, land-based retailing, the Walmarts, et cetera, of the world. We were big investors in wireless. That was actually our biggest area of investment back in our early days. We haven't had anything in wireless in, 15 years probably. I mean, it's turned into, then it was a new thing, and all the big telcos had to get into the game, and they were acquiring wireless companies, and it was a great thing for us. But now, it's just a commodity now. It's, you like see a zillion ads on TV, and these guys are just beating each other's heads in. So, a number of the things that were large areas of investment for us, we don't do anymore. And the things that are very large investment areas for us basically didn't even exist then, right?
A lot of them 5 years ago.
Yeah. So that's to me, the amazing thing about the U.S. economy is this, right? A number of the biggest industries and biggest employers in the country, you go back 50 years ago or 30 years ago, have their employment count has shrunk. They're mostly manufacturing type industries, right? But we've had massive growth in other industries, right, where we lead the world, right? Technology, entertainment, healthcare, right? They have filled those, and it's tough on some, if you're, a 50-year-old person who is working in a GM plant or whatever, it's hard to repot yourself. So it's incumbent on government to help, sort of bridge some of these gaps, but the economy is unbelievably dynamic, and that's that's one of the great attributes of this country, right? You just look at the value, all the most valuable companies in the world, like none. I mean, Europe, there's like none. Japan, none. I mean, like in the top 20 now. It's all the US or China.
So we have time for one more question. And Matt Berry, speaking of the ways in which you look at investing, he was wondering, do you see much merit in considering unloved or forgotten about companies in terms of investment?
Always, yes. But again, they have to, often they're unloved for a reason, right? There are areas of our, this is the, Schumpeter's creative destruction, right? I mean, there are areas of our economy that are in secular decline, right? I mean, we're not going to use as much fossil fuels 10 years from now as we're using today, right? If you're a fossil fuels based energy company, you're in decline, right? If you're a land-based retailer without much of a web presence, you've got problems. I would not want to own a mall, right? There are a lot of businesses that are, we've seen this, unfortunately in the publishing business, right? I mean, I would not want to be a cable channel without a lot of original content that people really want to watch, right? I mean, the cord cutting is not putting you in a good place. So there are a lot of businesses that are in secular decline. That doesn't mean they can't be reasonable investments, but there has to be a large either margin of safety in that or a catalyst somehow to change what they're doing. Because many businesses that are unloved for a reason.
Steve, I know that was the last question. I want to sneak one more in.
Okay.
That wasn't a very cheery last question anyway, so.
I don't know that this one will be cheery either, but it's just along the lines of what you were saying, and it sort of makes me think, that sure there were lots of companies in industries that needed to sort of fade or are fading. Did that have to happen to General Electric? I mean, when I think about General Electric and the storied company that it was, and what it manufactures and some of the things that we still need in this country today, it seems like they took a knockout punch. And I'm wondering if you think it could have been different.
Well, you're hitting in an area that's very close to home because the former CEO is a very good friend of mine. So, is a wonderful person, and was, I think, a wonderful leader who so I attribute their issues to two things. They still have some wonderful businesses, by the way, that have been, some bad luck happened to them, right? He took the job one day before 9/11, and I remember 9/11 happening. It was a airplane that we owned with engines that we made crashed into a building that we insured. Anyway, I attribute their issues to two things. One, or three things really. There was a culture set back by Jack Welch, which was very hard for them to admit that anything was wrong, right? We never, right? And that, I think, caused some cultural issues. There was stuff that was done back in that era that allowed them to make some quarterly earnings that came back to bite them literally 30 years later, that probably should have been identified along the way, but there was a very large write-off of a insurance contract which was basically a long-term care contract where their assumptions were wrong, like people were living longer and healthcare costs more money, so, you have a long-term care contract, your assumptions are wrong, and that snowballed. And then there were some, I think, well-intentioned but turned out to be ill-timed acquisitions. One in the energy space and one in the power space. And those were just ill-timed as, oil price cratered and the power markets, for a number of reasons, this is gas turbine markets got hurt. So, but they still have, they have two really outstanding businesses that are going to, one, obviously the jet engine business that has been hurt by COVID and people not flying as much, and they make money by the maintenance of those jet engines. And then their healthcare business is an excellent business, and so those will, the company will go on, and I think and I don't have an opinion about the share price, but the company's going to do fine.
Thank you, Bob. Thank you, Steve. It was a great conversation.
Thank you.
Tune in next week. We'll have a 2-hour version of this.